Welcome to Everyday Investor. My name's Nicole Edmonds and I'm filling in today for Rav Tour. Today we're going to learn about how we can make money investing in land development. Remember, before getting involved in any investment opportunity, you want to ask 4 questions to start. 1, what is my return on investment? 2, when do I get that return along with the money I put in? 3, what is the minimum cash amount needed to get involved? And 4, what is the risk in the worst case scenario? Grab your pen and paper and don't go anywhere. Everyday Investor begins in a moment. Coming up, Darcy McConvey teaches us how our money can make us money investing in land development.
Development of this scale is a very, very large market. And so we give individual investors the opportunity to invest in an asset class that typically is not accessible for most people, right? Like for me just to put my hand up and say, hey, I want to be a developer tomorrow, it's a very hard thing to do.
Everyday Investor is brought to you by ProFunds Mortgages, Fixed Returns, Real Security. Clover Properties Rent to Own, Invest with a Purpose. Sam McDaddy Real Estate, full service brokerage for all your buying, selling, and investing needs. Welcome back to Everyday Investor. I'm Nicole and I'm filling in today for Rav Tour. Today we're going to be learning about how we can make money investing in land development. I have an expert on the topic here, Darcy McConvey. He's the Director of Capital Markets at Greybrook Realty Partners. Darcy, thanks for joining us on the show.
Thanks for having me.
So Darcy, you've been on the show before, and what's new? What's new with you?
Well, on a personal level, the family's growing a little bit. So we found out relatively recently we'll be popping out our 3rd boy. So that will be fun and exciting and busy, but it's great. And then at the Greybrook, in the work life, we're really looking at a lot of interesting things, investing in sort of asset classes or areas we haven't invested before. And so it's exciting for us. And so it looks like 2019 will be a great year.
So Darcy, what does it mean? Let's start talking about what does it mean to invest in land development?
Sure. Greybrook, effectively what we are is we're a private equity group. So we have a large base of investors. And to invest in land development, basically we provide an opportunity for individual investors to invest in and alongside some of the largest developers in the areas that we invest. So traditionally Toronto, Greater Toronto area. And so really what it is we joint venture with developers at a very large scale. And we provide sort of the majority of the equity through Greybrook and its investors. Our developer partner would provide sort of the minority of the required equity, so of the cash investment. And then that joint venture, effectively, the agreement is our developer partner takes a project through to completion. And once the project is complete, we split profits with the developer sort of 50-50 on completion. So effectively, it's an opportunity for an individual investor to invest in very large scale development and share in the returns that this type of development generates.
So like you said, individual investors, so everyday people are investing their money with Greybrook, and then Greybrook is finding that relationship with a developer to pursue a project. Yeah,
so we have sort of strong relationships with, call it 10 to 12 of the largest builder developers in the areas that we invest in. And so we're not out there on a given day looking for new developer partners necessarily, but more about servicing the partnerships that we have. And we look at these as genuine partnerships. So we're not just a capital source, but we're a working and operating partner alongside our partners. So in terms of the structure, the investors really come through Greybrook, and we on a project by project basis. So we're not a fund like a mutual fund, but we're investing in a given project with a given partner, with a given timeline, and we're doing a certain thing, whether that's high rise, low rise, or something else. And you're investing in that specific project. So it's called a limited partnership, and it's a legal structure that sort of is in place to ultimately protect investors, really.
Okay, so as an investor, I can pick and choose what project appeals to me, is that right?
Exactly, and I think that's one of the really unique and interesting things about what we do is because we're not a fund, meaning that you're not investing and we're making that investment decision on your behalf. As an investor, you get to pick the project. So you get to pick the developer partner, the timeline, what we're building. Again, it could be townhouses, detached homes, high rise. So really, the unique thing about it is you can sort of build a portfolio within a development strategy that really suits the individual, and take a portfolio approach.
Okay, so talk a little bit about that. What are you, from those, the diversity of the different projects that you guys have, whether it be townhouse development or high-rise, what are you seeing timeline-wise, and what are you seeing return-wise as well?
In development, we kind of always target a return to double an investor's investment in 5 years or less. So that's going to correlate to a 20% annualized return or greater. So that's
20% annual return. Okay.
Yeah, so that's kind of the return profile that we're going to look to on the development side. And in terms of where we're investing and what we're investing in timelines, timelines can really range anywhere from sort of on the short term 3 years up to really 7+ years. And it really depends on what we're building and where we're building it and the stage that the land is at.
And so as an investor, to get involved in these deals, are you taking, as an investor, an active role, or is it a passive role? I mean, you're mentioning you're partnering with a developer, so are they doing everything and we're sitting back, or are we as investors involved as well?
So the investors aren't involved, so it's a very passive approach to development. And I think that's one of the unique things about what we do is when you think about real estate investing, and you guys are the experts on the topic broadly, but really there's only a couple ways to invest in real estate. It's through, you have your principal residence, you have a rental property or multiple rental properties that for cash flow or some sort of yield, and then you've got a private or public REIT, right? And that's really the only ways that most people can traditionally access real estate investing. And I think one of the unique things that we do is development of this scale is a very, very large market. And so we give individual investors the opportunity to invest in an asset class that typically is not accessible for most people, right? Like for me just to put my hand up and say, hey, I want to be a developer tomorrow, it's a very hard thing to do. So I think that's what makes ultimately what we do quite unique. And in so much as we opened up an asset class, I think, to many investors, smaller scale investors ultimately.
Yeah. And I think that's something that's so appealing when people think of investing in real estate and they think, okay, well, I need to flip a property or manage tenants. But if they can invest in a passive way and make returns, like you're saying, of 20% per year, like that's incredibly appealing to people who wouldn't otherwise have that opportunity.
Yeah, super passive for the investor, very active for Greybrook. We classify or say we're active asset managers. So from the investor perspective, the day you invest, there's no sort of responsibility on your end from that point forward. It's per our structure, it's Greybrook and its developer partner are in the day-to-day weeds, from working with sales and marketing, brokers, banks, lenders, all the way through to construction and completion. So we're very active, our developer partner is very active, and then ultimately the responsibility of the investor is just to collect a check on completion. So it's really as passive as it gets.
Yeah, very appealing.
Yeah.
Can you tell us a little bit about some of the different areas that you guys are investing in? You mentioned Toronto, but what are some of the areas that these developments are being done?
Yeah, so I'd say about 80% of our portfolio is Toronto, Greater Toronto Area, Greater Golden Horseshoe. So sort of that radius that wraps really Toronto is where the bulk of our portfolio is. And again, that's on the low-rise and high-rise side, the bulk of it being residential development. We also have a strategy called a value-add strategy where we're investing in other Canadian and US markets. So we're in Ottawa, Quebec, Montreal, and looking at a number of other markets on the value-add side. We're in Texas, Ohio, and a couple other US markets. And we have a very niche but interesting and growing strategy in South Florida where we develop rental that's really catered to the millennial demographic and the emerging trends that sort of millennials bring to affording real estate and how they live and what they want to live. Tell
us a little bit about that. You said that was in South Florida, and that it sounds a little bit different than the other projects. So tell us a little bit about that.
Sure. So with one of our US partners, PMG, Property Markets Group is the name of our partner, we have this strategy called X Living. So effectively what X Living is social living or building communities within a building. And so what we've done there is these are ground up developments, and they're rental. So they're not condo, but they're rental, high rise. And so what we've done is they're very technology rich. You've got an app to order room service, you've got an app to order car, you've got an app to give you access to my unit, or family access to your unit. So very technology rich, incredible amenities, pools, top-notch gyms, yoga areas, event spaces, WeWork, which is sort of shared workspace for entrepreneurs. And so super amenity rich, great restaurants inside the building, great coffee shops, and these are all public. So what we've effectively done is we've built sort of a community inside of a building, and really it is very targeted and very much sort of resonates with that millennial demographic, right? Because a lot of the millennials either don't want to own, can't afford to own.
But still want those high-end amenities and a nice place to live.
Exactly, and want to rent in a building with people just like them. And so it's gone very well.
Very interesting, Darcy. Well, thank you for coming. We've got more to talk about with Darcy McConvey right after this break. Everyday Investor is brought to you by ProFunds Mortgages, Fixed Returns, Real Security, Clover Properties Rent to Own, Invest with a Purpose, Sam McDaddy Real Estate, full service brokerage for all your buying, selling, and investing needs. Welcome back to Everyday Investor. We've been talking with Darcy McConvey about investing in land development. So Darcy, I'd like to go through and learn, kind of break it down to the numbers of how we can see these returns. We just talked about 20% per year, so let's break it down and see how that works.
To do that, I like to give an example of a condo, a single tower condo development.
Okay.
Because I think it's kind of the most visual and easiest way to sort of get to the bottom of it. So when we think about acquiring a site, typically, and the project we're going to be talking about here is about $100 million in total costs. Okay.
So $100 million is the total cost of the entire project.
Of the cost,
Okay.
Needed to complete the project,
Okay.
right? And so where Greybrook and its investors come in is typically we would be, in this case, say 15% of the cost. That would be our equity.
Okay.
So call it 12, and that 15% would make up 15 million. 12 of that 15 million would come from Greybrook and its investors, and 3 million would come from, call it our developer partner.
So the developer is putting money in as well to the project?
They are.
Okay.
Yeah. And so that would make up 15% of the total cost, right?
Yeah.
So the next 15% of the costs in this structure are actually sort of the pre-sale deposits. So in the late 90s, or sort of mid 90s, previous to that, developments used to be sort of sold or built and then sold, right? And so the bank said, I'll lend to this project, and then you sell it, and sort of that was the nature of how development worked. And then there was a crisis, right? So the last sort of real estate crisis, and the bank said, that wasn't the best idea. So how about this, Mr. Developer? You pre-sell the units, and then once you've pre-sold to a certain threshold, and so in this case, we'll say 70% of the units in the entire building, once you've sold 70% of the units in the building, now we'll give you the bank financing to construct the project, right? To complete the rest of the project. So 15% of the cost would be these pre-sale deposits that you have to put down. So when you walk into a sales center, you have a deposit that's 5, 10, 15%, 20% over a certain course of time. So those deposits are used as part of the capital structure.
Okay.
And the remaining 70% is now that the bank says, okay, great, the building's 70% sold, we'll now lend to the remainder of the cost, which is basically what you call your construction financing.
Okay.
So 70% of the total cost would be bank financed only after they felt comfortable that there was enough sales to take the project through to completion.
Which, as an investor, one would feel comfortable with that as well, knowing that before we start spending all this money developing, that we're already sold 70%. Is that the idea as well?
I think for sure. Banks are generally risk averse, so I think that they created a structure to make sure that they de-risk it along the way, right? Even when they say, okay, we know there's enough sales, now here's your construction financing, that only comes out in draws over time. It's not like they say, here's 70%, go for it. They monitor it and manage it. So I think the nature of how they lend de-risks the project,
Yeah.
to your point,
Overall,
for an investor
for everybody.
overall.
Yeah. Okay.
Yeah.
Okay. So we've got 15 million investors we're putting in, along with the developer. 15 million are coming from those pre-sale deposits, and then 70 million is being financed by the bank.
Yeah. So again, this is a high-res example, exactly.
Okay.
And so we're saying this project is, meets what we projected and generates about 30 million in profit. Then that 30 million is broken down in terms of the profit split, because earlier we talked about there's sort of a profit split between us, our developer partner. So that profit is typically split of the 30 million, 3 million in this example would go to Greybrook. Of the 27 remainder, 13.5 would go to the developer partner, and 13.5 would go to our investors.
Okay.
So back to ground zero where we started, investors put in 12 million of the 15 required, and they're getting their 12 million back plus 13.5, which is effectively more than a double of your investment in, call it 5 years.
Yeah, so they're making the 13.5 million as profit. They're also getting back their initial investment.
Exactly.
And in 5 years, over 100%. So that's where we're getting to around 20% return on investment per year annualized.
Exactly.
Is that right?
So that's kind of in simple form how it works.
Okay.
And one of the interesting questions I think always is well, why would a developer do that? Like, why would they give up some of the economics?
Yeah.
And the reality is, I think there's a couple reasons. One is, land is very expensive. So even someone with a lot of capital, you can only hold so much. You can only buy so much land. And if you're in the business of buying land 5, 10, 15, 20 years out for development, which a lot of the big developers are, then they need to hold land for a long period of time. So we give them a high return on their equity, but also the ability to now take some of that equity and buy land for 20-year development that's 15, 20 years away. So we give them the ability to scale and the ability to sort of keep that engine running.
So it's beneficial for them because they can do multiple projects. They're obviously making a great return on their money and doing all the work. We as investors are making over 20% return per year, so it's a great deal for us and doing no work. So it's really a win-win from either angle.
Yeah, absolutely. I think it's again, it's access to development that we couldn't otherwise get, and the returns that sort of coincide with this scale of development for sure.
And okay, tell me also, how does this look from? Are you getting this 5-year project, for example? Are you getting in, buying the land, rezoning it, developing it, selling it, or what? How is that process?
It really depends on the development. So, zoning's sort of a broad spectrum of zoning, but one of the things we don't do is we don't take what's called entitlement risk. So we're not going to buy land that's designated for sort of agricultural use or employment industrial and try to redesignate it or change the use to residential. So that's a risk that we don't take. It can be rewarding if you do it well, but it's very hard to do and not one that we want to take on our investors' behalf. So we would buy land that is designated for an intended use, so it could be low-rise or high-rise. Some land may be 2 or 3 years away from development, and some land may be ready to be built on right away.
Okay.
So it really depends on the project. We're opportunistic in the way that we buy land and buy sort of developments. And so as long as it sort of meets our underwriting criteria and we believe the upside's there, then we'll sort of play anywhere in that spectrum.
That makes sense. So let's talk a little bit about what some of the risks are with this kind of investing. Do you want to speak to that?
I think at the end of the day, as long as you're not overpaying for your land and you're not over leveraged, then as long as you, again, buy land well, then, our belief is we like to call ourselves sunset buyers in so much as the day the sun sets, the day you buy the land, that you're in the money or you've made money. Because we feel like we could hopefully sell that site the next day for more than we bought it.
So just on the buy, you're mitigating the risk.
So the buy is very, very important.
Okay.
Not being over leveraged on the buy. And if you can do that, then you're never in a position where you're going to be forced to sell, as long as you can carry the site. And in our structure, our partner also can't force us to sell. So these are very important things because if the market turns, you want to be able to withstand a down market and come back up in an up market. And you know what? I think the biggest risk in development, as long as you're buying well and you're structured it right, is ultimately the ability to wait. So, markets ebb and flow. Obviously, when we project our timelines, we want to be sort of on time or better, but things can happen in the market. And so as long as an investor has the ability to wait and buffer in maybe 10, 15, 20% longer timeline, then I think that's the biggest risk ultimately in investing with us.
Okay. And some of the funds, like people aren't necessarily always investing cash in these deals, right? Like these are, from what I understand in my experience, some of them are a registered fund available.
So to invest, you can invest with cash, whether personally or joint or through a corporation. It's a pretty flexible structure from that standpoint, and registered funds. So RSP, TFSA, LIRA, all of the projects are register plan eligible, and the minimum investment in any given project is $25,000.
Is $25,000?
$25,000.
Okay. So for a lot of people, like we were just talking about illiquidity and being able to wait. If somebody's investing $25,000 from, say, their RRSP, that might not be money that they were planning on accessing and using right away anyway. So as long as you're kind of planning that, then the risk lessens.
That's a great point. Yeah, you should actually work for us. One of the things that we always say is that these longer term funds like RSP, LIRA type funds match up quite well with sort of longer term projects, and it's a really efficient way to invest. So it's a good point. Long term funds and long term projects make a lot of sense.
Awesome. Well, time flies, Darcy. We've run out of time for today, but thank you so much for coming and educating me and our audience on how to make money investing in land development. And thank you to our audience. Whether you're watching online, on TV, or listening to our podcast, thanks very much for tuning in. For more information on this show, or if you would like to become an Everyday Investor Insider and receive investment opportunities, tips, and advice, visit our website at everydayinvestor.com. We'll see you next week, same place, same time. Thanks, everyone.